Welcome. In this video, we'll cover the accounting cycle for merchandisers along with the multi-step income statement and closing entries. This video will retread some of the ground covered in my video on the closing process for a service company. If you didn't watch that video, don't fret. I'll cover everything you need to know. I should also note that this video covers the aforementioned items for merchandisers who use the net method for accounting for inventory purchases and sales. If your course uses the gross method, I suggest you watch video 9B instead. Let's do a high-level summary first. The accounting cycle is the series of tasks performed by the accountants every month, quarter, or year, as the case may be. Depending on your textbook, the cycle may consist of as few as 6 steps or as many as 10, depending on whether they are combined or separated. But the general process is as follows. First, we record journal entries and post them to the ledger throughout the month, quarter, etc. as the transactions occur. Purchase supplies, record and post. Make a sale, record and post. Pay off a liability, have some equipment repaired, collect a receivable, record the journal entries, and post to the ledger. Once we arrive at the end of the month, or quarter, or year, we then prepare the trial balance. This is a check to make sure total debits equals total credits. If the two do not balance, we know we have an error that must be corrected before proceeding. Next, we record and post our adjusting journal entries. Remember, these are the transactions that we didn't necessarily receive a source document telling us to do anything. Expensing prepaid assets like prepaid rent or prepaid insurance, accruing expenses or revenues, adjusting unearned revenues. These are our adjusting entries that must be recorded to ensure that our records are as accurate as possible as of the end of the period. Once the adjusting process is complete, we prepare another trial balance, commonly called the adjusted trial balance. Note that the previous trial balance is correspondingly referred to as the unadjusted trial balance. The purpose of the adjusted trial balance is the same as the first one. Verify that total debits equals total credits. If they don't balance, we know we have an error that must be rectified. Furthermore, if debits don't tie to credits on this trial balance, but they did on the previous one, we know the error occurred somewhere in the adjusting process. If we neglected to build the unadjusted trial balance, we'd have no idea where that error occurred. It could have happened all the way back with the first journal entry in step 1. Building these trial balances offers a quick way to isolate where any mistakes may have occurred and hopefully quickly identify and correct them. Next, we build the financial statements, the income statement, the statement of owner's equity, the balance sheet, and eventually the statement of cash flows. After building our financial statements, we record and post our closing journal entries. These entries will move our revenue and expenses into our owner's equity. We'll talk more about these entries momentarily. Finally, we prepare our post-close trial balance. Like the others, this trial balance once again verifies that total debits equals total credits as a check against errors. And we repeat the cycle afresh next year, month, and so forth. If these steps seem like a lot to remember, you only have to remember steps 1, 3, 5, and 6. After that, just remember that after recording and posting any journal entries, you do a trial balance to ensure that debits equals credits. For the purpose of this example, let's imagine we've already recorded and posted our journal entries as they occurred during the month. We pick up this process in our accounting cycle with step 2. At this point, we've already recorded our journal entries for the transactions that occurred throughout the month. Once we've finished with the last of those journal entries, we prepare our first trial balance, commonly known as the unadjusted trial balance. This worksheet simply shows each account with its respective debit or credit balance. At the bottom, we see that total debits equals total credits. This reconciliation doesn't guarantee that everything is right. Imagine we make a cash purchase of supplies for $1,000, but instead of debiting it into supplies, we debit it into merchandise inventory. Total debits will still equal total credits, but $1,000 of our debits are in the wrong account. However, if total debits does not equal total credits, we know for certain that something is amiss. Since we're in balance, we can proceed to the next step. Next, we prepare our adjusting entries. Of course, we record these as I discussed in video 5. Let's imagine that we have the following adjustments. First, we recorded depreciation expense on store and office equipment in the amount of $1,100 and $900 respectively. We'll also accrue sales and office salaries expense in the amounts of $40,800 and $61,200 respectively. Finally, we earned a portion of advanced customer payments, unearned revenue, for $7,000. Once we've finished recording and posting our adjusting entries, we prepare our adjusted trial balance. Again, we need to make sure total debits equals total credits before proceeding. We'll update this spreadsheet based upon the previously prepared adjusting entries. First, we post the debits and credits from our depreciation adjusting entries. The balances become updated accordingly. If you're a bit flummoxed as to how these adjusted balances are determined, just build a T account. Consider depreciation expense on office equipment. We have a beginning debit balance of $17,100. We just posted a debit of $900. Consequently, the adjusted balance becomes $18,000. We'll do the same process for accrued employee expenses as well as unearned revenue. Take a moment to notice the impact of these debits and credits on this sheet. Office and sales salaries had debit balances in the unadjusted column. The debits from the adjusting entries gave us increased debits in their adjusted columns. As for unearned revenue, that account had an unadjusted credit balance, so the debit from the adjustment lowers that credit balance. Again, if you're not certain how this works, just build the T account. All the other accounts that weren't adjusted will keep their unadjusted balances. You can observe that these accounts, like cash, accounts receivable, notes payable, and so forth, have the same adjusted balance as their unadjusted balances. Finally, we do our sanity check and verify that total debits equals total credits, both for our adjustments and our adjusted balances. Next, we build our financial statements. We prepare our financial statements in the same order as previously discussed. However, the income statement we observed in the previous videos was a single-step income statement. That one was very simple. We simply listed all revenues, summed them, did the same for expenses, and took the difference of total revenues and total expenses to arrive at net income. That method is sufficient for small service companies, but merchandisers prefer an income statement that provides a little more information. For that reason, we have a multi-step income statement. All of our revenues and expenses will show up here, but they'll be grouped differently than on a single-step income statement. Let's consider the income statement of R&F Bicycles. First, we list our net sales and subtract out cost of goods sold to arrive at gross profit. Cost of goods sold is almost always the most significant expense of a merchandiser. It's the cost that consumes most of the revenue, so we subtract it first. The resulting difference, gross profit, tells us how much money we have left to cover all remaining expenses. Next, we have our operating expenses. Most of our expenses will be conveyed here. These are those costs we incur in the actual running of the business. Within operating expenses, companies typically further divvy them up by sales and marketing and general and administrative expenses. Sales and marketing are those expenses incurred for the purpose of generating revenues. What we pay our sales staff, depreciation on store equipment, rent on our retail space, and advertising are all common examples. General and administrative expenses are basically those that don't directly generate revenue, but they're essential for running a business nonetheless. For example, what we pay our office employees. The jobs of accountants, HR managers, or IT technicians don't directly result in customers making purchases, but the business won't function very well without them. Similarly, depreciation on office equipment, rent on the office space, and office supplies are all related G&A expenses. Another way of thinking about these two subcategories is that those expenses that occur in a retail space are sales and marketing, and those that occur in the corporate office are G&A. We then sum all of our operating expenses and subtract that amount from gross profit to arrive at income from operations. This is just what it sounds like. How much money did we earn through conducting our business activities? Next, we list our other revenues and expenses. This section is kind of like the junk drawer of the income statement. Expenses and revenues that don't neatly fit into S&M or G&A go here. Most commonly, interest expense on borrowings or interest revenue or dividend revenue from the business's own investments show up here. We combine this amount with income from operations to arrive at income before taxes. Deduct the income tax expense and we're left with net income. I know this looks like a lot, but you just have to memorize the process. Sales minus cost of goods sold equals gross profit. Subtract operating expenses from gross profit to get income from operations. Remember that operating expenses contain both S&M and G&A expenses. Then subtract or add other expenses and revenues to get income before taxes. Subtract out taxes to get net income. I've never been able to come up with a handy mnemonic device for this item. If you have one, please leave it in the comments. The rest of the financial statements are prepared as usual. The statement of owner's equity will take the beginning owner's capital balance, add in any contributions as well as net income, then subtract out drawings to arrive at ending owner's capital. Same again with the balance sheet. We start with our assets and list our current assets and total them. Do the same for plant, property, and equipment. Combine total current assets with total PP&E, and we have total assets. Build your liabilities section. You'll have current and non-current or long-term liabilities. List your current liabilities, sum them. In this case, we only have one long-term liability, so there's no need for a sum, but if we had multiple, we would list them and sum them just as we did right in here. So sum up our liabilities to get our total liabilities, and next build owner's equity. For this class, since we're looking at a sole proprietorship, owner's equity will just have owner's capital, and this amount comes from the ending owner's capital balance on the statement of owner's equity. Combine your total liabilities with your owner's equity or your owner's capital, and you arrive at total liabilities plus equity. Again, note that total assets reconciles to total liabilities plus equity. Next, we record and post our closing entries. Before we talk about the actual journal entries, we need to distinguish between permanent or real accounts and temporary or nominal accounts. Permanent accounts retain their balances from one year to the next. In other words, their balances are literally permanent. Our permanent accounts consist of our balance sheet accounts. As an example, think of the cash account. If you have $10,000 in your cash account on 11:59 p.m. on December 31st, how much cash do you have as soon as the time rolls over to 12 a.m. on January 1st of next year? You still have $10,000, right? You can apply the same reasoning to just about any item on the balance sheet. If you have an account payable balance of $1,000 on December 31st, you still owe that amount the next day on January 1st. Your debtor doesn't wipe away your obligation just because the new year arrived. These characteristics are the opposite of our temporary accounts, whereas permanent accounts keep their balances from one year to the next. Temporary accounts are reset to zero right before the start of the new year. Our income statement accounts, specifically revenues and expenses, as well as drawings, are our temporary ones. To understand why we reset them to zero, consider what would happen if we didn't. Imagine we had $1 million in revenues sitting in our sales account. Now imagine we earn $1 million in revenue every year for the next 4 years. Our account would have $5 million in revenues. But that balance doesn't give any indication as to how much money we've earned in the current year. Do that for enough years, and you might have $1 billion in revenues, but we'd have no idea how we performed in the current year. That's why we reset the balance to zero right before the new year starts. Looking back at our adjusted trial balance, we can identify our temporary accounts that will reset. Specifically, our drawings, revenues, and expense accounts. How will we zero them out? With a journal entry, of course. Let's start with our income statement accounts. Our revenues have credit balances, so if we want to move them to zero, we'll have to debit them. As for our expense accounts, they have debits, so we'll zero them out with credits. At this point, if we sum our total debits and credits for this journal entry, we'll find that we're out of balance. Specifically, we need $445,250 in credits to make both columns tie. If this number looks familiar, it should, because it's our net income. We have all our revenues in our debit column and all our expenses in our credit column. So what's the difference between revenues and expenses? Net income, of course. This credit will go to our owner's capital account. Effectively, we've transferred all of our revenue and expense account balances into owner's capital. If you need further explanation, imagine the impact of this journal entry on those accounts via their T accounts. Fees earned and sales of merchandise have their credit balances, so the debit from the journal entry puts them at zero. As for our expense accounts, they all have debits, so the credits from our closing entries will also reset them to zero. Once we've closed out our income statement accounts, it's time to do the same for drawings. Again, if we didn't, we'd eventually have a huge balance in it with no idea how much the owner had withdrawn during the current year. Right now, we have an adjusted debit balance of $353,750. To clear it out, we'll credit drawings and debit owner's capital, so the credit from our journal entry moves the drawings account balance to zero. Let's consider the impact of these entries on the owner's capital account. Here we have our previous two closing entries. I've changed their colors in order to help you distinguish them from one another. The green items are for closing revenues and expenses. The blue items are for closing drawings. With each of these entries, we booked an amount to owner's capital. If you look back at the adjusted trial balance, you'll see that the current balance is $2,138,500 in credits. We can depict this balance as a T account seen here. We then post the credit from the income statement closing entry and the debit from the drawing closing entry. Our new balance becomes a $2,230,000 credit. Hopefully that new balance looks familiar, as it's our ending owner's capital balance from the statement of owner's equity. As of the posting of our closing entries, our owner's capital accounts should align with the statement of owner's equity. Consider what we did on that financial statement. We took the beginning year's owner's capital balance, added in contributions and net income, then subtracted out drawings. We did the exact same thing to the T account by the way of these closing entries. We started with our beginning balance, added in net income, and subtracted out drawings. My point being, our closing entries will adjust owner's capital to the ending balance in the statement of owner's equity. If that's not the case, there's a mistake somewhere. Let's talk more about these closing entries. Consider this example separate from R&F bicycles. We have the following balances in revenues, expenses, owner's drawings, and owner's capital. The general process we just saw was to first debit revenues and credit expenses for their respective balances, then plug the difference to owner's capital. The debit from revenues will reset that account to zero. The credit to expenses will do the same, and owner's capital will increase by an amount equal to that year's net income. We then close out drawings with a credit and debit its balance into owner's capital. We post our ledger accounts, and owner's drawings returns to zero, and owner's capital arrives at an ending balance of $75,000. There are other ways you can close out these accounts, and depending on which text your course is using, you may see these entries performed in a different manner. Note that while the process may be slightly different, you'll always arrive at the same result. Allow me to show you one such alternative entry in the bottom left corner of your screen. I've included the previous closing entry in red so you can observe how this one is different, yet it yields the same result. Under this method, you could close out your revenues and expenses separately. Here, we debit revenues for its balance and credit owner's capital. Next, we credit expenses for its balance and debit owner's capital. Look at the result of posting these journal entries to their ledgers. The net effect of the debit and credit to owner's capital is a net credit of $60,000. The exact same amount as in our previous example. In both instances, we credited owner's capital for the value of the year's net income. Then, we close out drawings just as we did previously. When all is said and done, we have an ending credit balance of $75,000 in owner's capital, exactly as in the previous example. One more way you may see the closing entries booked, depending on your course, may involve an account called Income Summary. Again, I've included the previous example for comparison in red. This method is almost identical to the previous one, save for the new account. We'll close out our revenues and our expenses individually, but we'll initially move their balances to the Income Summary account. In other words, debit revenues and credit income summary for $100,000, bringing the revenue account to a zero balance. Debit income summary and credit expenses for $40,000, bringing expenses to zero, and income summary to a $60,000 credit balance. At this point, income summary has a credit balance equal to the year's net income. This means that no revenue or expense account has been overlooked, so we can close income summary to owner's capital. Close out drawings just as we've done in every other example, and owner's capital will have an ending balance equal to the year-end balance on the statement of owner's equity. Next, we record and post our closing entries. Here we see the ultimate impact of those closing entries. That is, revenues, expenses, and drawings are all reset to zero for the upcoming year, and owner's capital has the ending balance from the statement of owner's equity. Again, those balances from all the temporary accounts have been transferred into owner's capital. So only our permanent accounts have balances going into the new year, and the ending owner's capital account balance matches the calculated amount from the statement of owner's equity. We can also verify that total debits equals total credits after our closing entries. If they don't, an error needs to be identified and corrected. That completes our accounting cycle. With the arrival of next year, the entire process will repeat itself. That concludes this video on the accounting cycle. The next video will address how to post to ledger accounts in manual systems. As usual, thank you very much for watching. If my videos are helping you and you want to return the favor, you can leave a thumbs up. If you have any questions or suggestions for how I can improve, leave them in the comments below. If you really want to help, temporarily subscribe to my channel. Not forever, just for however long you're taking your accounting course or courses. Finally, share my videos with your classmates and perhaps your professor. I'd like my videos to help as many students as possible, and I wouldn't mind getting some input from contemporaries. Thank you once again, and I'll see you in the next one.